investment. The world's financial system is built on trust, and right now, that trust is being tested. For decades, the US dollar has been the dominant global currency, the backbone of trade, investment, and savings worldwide. But the reality is that the dollar is not invincible. Inflation is quietly eroding its purchasing power, and the national debt is climbing to levels we've never seen before. Every time the government prints more money, the value of the dollar decreases, and the confidence of everyday investors and international players begins to waver. In this environment, gold reemerges as a timeless safeguard. Unlike paper currency, gold cannot be printed at will. It has intrinsic value, and for thousands of years, it has served as a store of wealth. When economies face uncertainty, when governments struggle to maintain fiscal discipline, investment, and when inflation spikes, gold becomes a refuge. People instinctively turn to it because it retains value even when currencies falter. The ongoing debate between gold and the dollar isn't just theoretical. It's about security, preservation of wealth, and long-term stability in an unstable world. Interest rates are another critical piece of this puzzle. When the Federal Reserve lowers rates, borrowing becomes cheaper, but the dollar's strength often declines. Investors start seeking alternatives that can protect them from devaluation, and gold shines in this scenario. Conversely, higher interest rates can strengthen the dollar but reduce gold's relative appeal. The interplay between monetary policy, inflation, and investor behavior creates a dynamic battlefield where gold and the dollar constantly compete for trust and dominance. For anyone looking to protect and grow their wealth, the lesson is clear. Diversification isn't just a strategy, it's survival. A smart approach involves balancing dollars, gold, and other assets. Dollars are essential for liquidity and everyday transactions, but gold provides insurance against economic storms. Understanding how each asset reacts to policy changes, market sentiment, and global events allows investors to navigate uncertainty with confidence rather than fear. Ultimately, the battle between gold and the dollar is more than numbers on a balance sheet. It's a test of trust, discipline, and foresight. Those who understand the underlying forces, monitor economic indicators, and make strategic choices will not only survive potential downturns, but can thrive in them. In a world where nothing is guaranteed, being prepared, informed, and proactive is the ultimate defense. The dollar and gold aren't enemies, they're tools. And knowing how to wield them wisely might be the key to preserving wealth and navigating the economic challenges ahead. The US dollar has long been considered the backbone of the global economy, but its position is increasingly fragile. For decades, it has served as the primary reserve currency, trusted by governments, corporations, and individuals alike. This trust is built on the belief that the dollar maintains its value and that the institutions behind it are stable and reliable. However, recent economic conditions have begun to challenge this perception. Inflation, which reduces the purchasing power of money over time, has become a significant concern. When prices rise faster than wages, the same amount of money buys less than it did before. This means that the dollar, while still widely accepted, is slowly losing the value it once held, eroding confidence among investors and everyday citizens. A good investment. Adding to this pressure is the massive national debt. The United States government has been borrowing at record levels for years, funding everything from infrastructure projects to social programs. Investment. While borrowing itself isn't inherently bad, excessive debt can be dangerous if it grows faster than the economy or becomes difficult to service. When debt levels climb without clear strategies for repayment, investors start to question whether the country can maintain the stability required to uphold the dollar's value. This doubt can lead to shifts in global markets as both institutional and individual investors begin seeking safer stores of value. The dollar's fragility is further highlighted by the policies used to manage economic slowdowns. Quantitative easing, or the injection of money into the economy by central banks, is intended to stimulate growth. Yet, when money is effectively printed to cover spending or boost liquidity, it can devalue the currency. The more dollars in circulation, the less each one is worth relative to goods, services, and other currencies. While these measures can prevent immediate crises, they can also contribute to long-term uncertainty, making the dollar less reliable as a store of value. Another aspect of the dollar's vulnerability lies in international dynamics. Global confidence in the U.S. economy and its political stability underpins the dollar's dominance. Any signs of instability, whether economic, political, or social, can prompt other nations to diversify their reserves away from the dollar. This could reduce demand for the currency investment, further weakening its position on the world stage. In essence, the dollar's strength is tied not just to domestic policy, but also to global perception. In practical terms, these factors mean that individuals relying solely on the dollar to preserve their wealth are increasingly exposed to risk. Savings held in cash, for example, may lose purchasing power over time, while investments denominated in dollars may be impacted by fluctuations in the currency's value. Understanding the fragility of the dollar is therefore essential for anyone serious about protecting their financial future. It's not just a matter of numbers on a statement. It's about trust, stability, and the long-term preservation of value. Recognizing this fragility allows investors to make informed decisions about diversification, seeking assets that can hedge against currency weakness and economic uncertainty. The reality is clear. While the dollar remains dominant, its position is not unshakable. Good investors are already looking for ways to safeguard their wealth against potential instability. Gold has always held a unique position in the world of finance, serving as both a symbol of wealth and a practical tool for preserving it. Unlike paper currencies, which governments can print at will, gold has intrinsic value that is widely recognized across cultures and centuries. Its scarcity, durability, and universal acceptance make it a reliable hedge against economic uncertainty. Whenever there are signs of instability, whether through rising inflation, volatile markets, or geopolitical tensions, investors naturally turn to gold as a safe haven. This is not a modern phenomenon. History is filled with examples of societies relying on gold to maintain stability during times of crisis. The appeal of gold lies in its ability to retain value even when other forms of money falter. Unlike fiat currencies, which can lose purchasing power due to inflation or excessive monetary printing, gold's supply grows slowly and predictably through mining. This scarcity ensures that its value remains relatively stable over time. During periods when confidence in the economy diminishes, such as recessions or periods of hyperinflation, gold often rises in value precisely because people seek an alternative that is tangible and reliable. Investors recognize that while the dollar or other fiat currencies can fluctuate, gold offers a degree of certainty in an uncertain world. Another reason gold is so attractive during economic instability is its liquidity. It is universally recognized and can be bought or sold anywhere in the world, making it accessible for both individual and institutional investors. This ease of exchange adds to its safety as an investment, as it can quickly be converted into cash or other assets if needed. In addition, gold is not dependent on the performance of a single company, government, or economy. Its value is based on broad, long-term principles of scarcity and demand rather than short-term economic policies, making it a powerful tool for diversifying portfolios. Gold also serves as a psychological anchor for investors. In times of uncertainty, people often look for stability and security, and owning physical assets like gold can provide that reassurance. Unlike stocks or bonds, which can fluctuate dramatically due to market sentiment, gold represents a tangible form of wealth that has been respected and trusted across generations. This psychological aspect plays a significant role in why gold demand rises when confidence in other assets weakens. Moreover, gold's performance often moves inversely to the dollar or other fiat currencies. When the dollar loses strength due to inflation, high debt levels, or monetary easing, gold tends to rise in value as investors seek to protect their purchasing power. This inverse relationship makes gold an essential component in strategic asset allocation. By including gold in a portfolio, investors can hedge against currency risk and reduce exposure to market volatility. Ultimately, gold is more than just a commodity. It is a financial safeguard. Its enduring value, universal acceptance, and historical track record make it one of the most reliable tools for protecting wealth during periods of economic uncertainty. Investors who understand gold's role as a safe haven are better positioned to navigate market fluctuations, preserve purchasing power, and maintain stability in their financial strategies. In a world where economic conditions can shift rapidly, gold remains a timeless refuge, providing security when confidence in currency or markets wavers. Interest rates, inflation, and market dynamics are deeply interconnected, and understanding their relationship is essential when analyzing the battle between the dollar and gold. Interest rates, set primarily by central banks, act as one of the most powerful tools in influencing economic behavior. When rates are low, borrowing becomes cheaper, encouraging spending, investment, and economic growth. However, Low interest rates also reduce the yield on savings and fixed income investments, making cash and dollar-denominated assets less attractive. This often drives investors toward alternative stores of value, such as gold, which doesn't yield interest but maintains intrinsic worth and serves as a hedge against currency depreciation. Conversely, when interest rates rise, the immediate effect is an increase in borrowing costs, which can slow down economic activity. At the same time, higher rates make dollar-denominated assets like bonds more appealing as they offer better returns relative to risk-free cash holdings. This dynamic tends to strengthen the dollar, reducing the immediate demand for gold as an investment. Investors weigh the trade-offs between potential returns from interest-bearing assets and the stability of gold, making strategic decisions based on current monetary policy and anticipated shifts in rates. Inflation plays a complementary role in this interplay. Inflation measures the rate at which prices for goods and services increase over time, directly impacting the purchasing power of money. When inflation is high, the real value of dollars declines, and people's savings lose their worth unless they are invested in assets that appreciate at least as fast as inflation. Gold historically performs well during inflationary periods because it is not tied to a government-issued currency and retains tangible value. Investors often flock to gold as a hedge against rising prices, viewing it as insurance against the erosion of wealth caused by inflation. Market expectations and sentiment also have a significant impact. Investment. When investors anticipate that central banks will adjust interest rates to combat inflation or stimulate growth, they adjust their positions in advance. For example, the expectation of prolonged low interest rates may increase the demand for gold, while anticipated rate hikes can shift attention back to dollar assets. Similarly, geopolitical events, trade tensions, or fiscal policy changes can influence how markets perceive risk, which in turn affects the attractiveness of both gold and the dollar. The interaction between interest rates, inflation, and market behavior creates a dynamic environment where both gold and the dollar compete for investor trust. A weakening dollar due to low rates or inflation encourages gold investment, while strong monetary policy and higher yields strengthen the dollar's position. Savvy investors recognize that this relationship is not static. By monitoring central bank policies, inflation trends, investment, and market reactions, they can strategically allocate assets to balance risk and reward. Ultimately, the relationship between interest rates, inflation, bets, and market dynamics illustrates why the dollar and gold are constantly in flux. Gold gains value when trust in the dollar declines, while the dollar strengthens when policy decisions reinforce confidence. Investment. Investors who understand these connections are better positioned to protect their wealth, make informed decisions, and take advantage of opportunities as they arise. The careful analysis of interest rates and inflation is not just a technical exercise, it's a strategic approach to navigating the complex financial landscape. Recognizing how these factors interact provides clarity in choosing when to rely on gold, when to favor dollar-denominated assets, and how to create a balanced portfolio that can withstand economic uncertainty. Balancing investments between the dollar, gold, and other assets is one of the most critical strategies for protecting wealth during uncertain economic times. No single asset can provide complete security, and relying solely on the dollar or only on gold exposes investors to different types of risk. The key is diversification, spreading investments across multiple asset classes to reduce vulnerability to fluctuations in any one market. A well-structured portfolio allows individuals to maintain liquidity, hedge against inflation, and capture opportunities while minimizing potential losses. The first step in strategic allocation is understanding the role of each asset. Dollars are essential for daily transactions, investment, short-term savings, and liquidity needs. They are stable in the sense that they are widely accepted and can be readily used to purchase goods, services, or other investments. However, holding too much in cash exposes investors to the risk of inflation, which steadily erodes purchasing power over time. Recognizing this limitation encourages investors to allocate a portion of their wealth to assets that can preserve or increase value under different economic conditions. Gold, on the other hand, functions as insurance. It is less about immediate gains and more about security and stability. In times of economic stress, when currencies are devalued or markets are volatile, gold tends to maintain or increase its value. Including gold in a portfolio provides a hedge against inflation and currency depreciation, giving investors confidence that a portion of their wealth remains protected regardless of market turmoil. The percentage of gold in a portfolio may vary depending on risk tolerance, financial goals, and economic outlook, but even a modest allocation can significantly reduce overall risk. Beyond dollars and gold, other assets play a role in creating a resilient investment strategy. Stocks, bonds, real estate, and alternative investments offer opportunities for growth, income, and diversification. And stocks can provide long-term growth and dividends, while bonds deliver relatively stable returns and lower risk. Real estate adds both appreciation potential and income through rentals. Alternative investments, such as commodities or cryptocurrency, can further diversify a portfolio and serve as additional hedges against inflation or currency weakness. Combining these assets with dollars and gold creates a balanced approach that allows investors to navigate different economic scenarios. Timing and adaptability are also essential components of strategic investment. Markets and monetary policies are constantly changing, which means a static allocation may not always provide optimal protection. Investors who monitor economic indicators, interest rates, inflation trends, investment, and geopolitical developments can adjust their portfolios to manage risk and seize opportunities. Regular portfolio reviews and rebalancing help maintain the right mix of assets, ensuring that risk remains controlled and objectives are aligned with changing conditions. Ultimately, strategic investment decisions are about foresight, discipline, and preparation. Balancing dollars, gold, and other assets is not simply a defensive measure. It's a proactive approach to managing wealth in an unpredictable world. Investment. Those who understand how different assets respond to economic pressures can make informed choices, protect their financial future, and even leverage opportunities that arise during periods of volatility. Investment diversification and strategic allocation are not just concepts. They are practical tools that empower investors to navigate uncertainty with confidence, resilience, and long-term perspective.